Ladies and gentlemen, I am honored to host the strategy meeting for, I guess we're in May already, but we have passed earnings season, and as many of you know, we do conduct a strategy meeting. Now, we used to do this behind closed doors. We used to have a meeting after market hours and talk about the strategy meeting. And then we decided, hey, why don't we do this live and give the listeners out there some insight as to what we're thinking and how we're thinking. We come up with themes and some of the things you should be looking out for over the course of the next month or so. And so that means we're going to bring in our trading team. And the man I'm going to start with today has been front and center in the line of fire of COVID. And that means I'm going to bring in chart trader Brett Manning. Brett, if you don't mind, give us a little update as to how you and your family are doing.
Hey, Jim. So first off, I apologize if you hear some background noise. One of the protocols we have is that all the doors and windows are open at all times. So so I have 3-year-old triplets, and they tested positive. My wife tested negative, but the doctor believes she was positive. I've tested negative twice. I was tested again yesterday, and I'm waiting for the results now. If I test negative again, then I think that I'll be past really risk. We've taken a lot of extreme protocols, my wife and I have, to prevent transmission from our kids to us. They have had some symptoms, but not too bad, and they're on the mend. And the person who brought it into the house was an aunt, my wife's aunt, and she's doing well too. She's on the mend now. Her fever's gone down. She's doing better. It looks like she's going to be headed in the right direction here, though she still has symptoms. And you know, I think that it's really been an interesting experience. As soon as we knew that it was in the house, and some of you may go through this, I can tell you what we've learned. The first thing to do is open all the doors and windows and turn off the circulating air and just disinfect everything and put fans on, heat with space heaters if it's cold, but you do not want circulating air on. That was a good step. That probably reduced the chances of it getting to myself or maybe my wife. But I've been taking direct care of multiple people with symptomatic COVID-19 in the same room with me for 10 days now, and I'm still negative. So that's possible if you take precautions. I've taken extremely strict protocols. So a lot of personal protection equipment, a lot of showers, a lot of laundry, a lot of disinfecting, and I've managed to avoid being infected, I believe. My doctor keeps wanting to retest me because he keeps believing, and I have a genetic high blood pressure, so I would be somebody who was at risk if I were to catch it, so he wants to keep testing me because he just can't believe that I could be in that situation and not catch it. I guess it's possible that I had it in the past and I have antibodies, but I really haven't been sick at all in the last several months, so I doubt it. I guess I could have had it asymptomatically. That's rare for somebody with high blood pressure. So we'll see, but and I will get an antibody test at some point. But fact of the matter is, at this point, I feel great, and the kids are getting better. My aunt is getting better. My wife has no symptoms, and it's possible to be in a situation where you're constantly surrounded by it and not get infected, which I think is actually a really positive point to make. If you use good protocols and personal protection equipment, you can prevent transmission. So, that suggests. And the other thing it also suggests, I really hate to see a movement toward people trying to say that this is just a nursing home disease. Again, we have 3-3-year-olds. They all caught it. They all got sick. They all got fevers. They've all been throwing up, diarrhea, all sorts of stuff going on there. And they're all getting better now, but they were definitely sick and very sick. And they're on the mend. They're headed in the right direction for sure. But it is not just an old person's disease. It is not just a nursing home disease. And kids can get it. Anybody can get it. So, but anybody can also choose to not get it by taking the proper precautions. So I think that's, it's not that you can't do anything in life. You can be right around it. And if you take the right steps, you can prevent transmission. You can prevent catching it. So I think that's really an encouraging idea. And we're doing great. We are going to come through this stronger than ever. So there's your update.
Well, since you're given a PSA about how you can avoid it, if you don't mind sharing how you suspect the virus actually got into the household, how it actually,
We pretty
how
much
the, how,
know, yeah.
are you able to share that?
Well, so my wife's aunt was staying with us to help with childcare, and I think she just wasn't quite as conscientious as we were, and I remember hearing her at one point say that the wearing a mask made her feel claustrophobic, and she would occasionally go to the store and get things, and according to her, she really hadn't been anywhere else, and I just kind of, I instinctively, get the sense that maybe she just was willing to go through and do just basic shopping without wearing a mask, and I think that that's probably where it came from. We know that it wasn't myself or my wife, and she was with them sort of on shift doing childcare for a couple days in the middle of the week 2 weeks ago, and then suddenly she said she didn't feel well. She took her temperature. She had 101-degree fever. She went home back to her place and got tested the next morning, and she was positive. And then a few days later, we tested the kids, and they were positive. So we're pretty sure that's where it came from.
So what that tells me is a ringing endorsement from the Manning family to take all precautions, wear your masks, and do what you need to do to get through this, and hopefully you cross our fingers.
It's not that hard, yeah. To prevent transmission, it's not that hard.
And look how easily it was. You wouldn't think, people would scoff at the not wanting to wear a mask at the grocery store, and, it's very plausible that might have been the culprit there. So we are so glad that you are well and that things are on the up and up for your family. And I know a lot of the listeners were curious, and, well, that would explain why you haven't been trading all that much. So welcome back, Brett.
I've been taking care of a number of different people who have this disease, and it's a full-time job. I've basically been a nurse in an infectious disease ward for the last 2 weeks.
Well, throw that on your resume as well.
Yeah, I've learned a lot.
There you go. All right, Brett. So let's get on to the markets here. And you're a great person to ask. Gavin and I talk about this quite a bit, about there really being a disconnect between the economy and just overall bearish sentiment, yet we see the market continuing to probe higher. It seems like the 2200 area in the S&P is a galaxy far, far away now. So what's your overall take as for what you're seeing?
So, I think that the remarkable kind of paradox or dichotomy here, what the market is doing and what people seem to feel about the situation are tremendously at odds. And it takes some work to interpret here. If you just look, so I want to kind of sort of say that let's split the universe into here. Let's look at just sort of historically. If this time isn't different in terms of just data, just looking at what the market is doing, how it's behaving, how it feels, just doing some tape reading and looking at sentiment data, just if we don't imagine that this is somehow an alien situation, then this has all the hallmarks of something that's just going to be at all-time highs in a couple months. That's undeniably what starts to show up in the data. The way the market is behaving and the fact that we have, for instance, money market fund assets are way at all-time records. We've got nearly $5 trillion locked up in money market funds. It's way more than we had. I think it's something like 25% more than we saw when we had the spike of just cash building in money market funds following the collapse of Lehman. So we've got way more than that now. We're sitting on just a mountain of people who have just pushed everything to the sidelines and just said, I just want to make sure that I get my money back. I don't want to lose it all in the coming depressionary crash that's on the way. So that's the mentality as we see this rally. And we've seen a rally that has been, well more than 10% over a 7-week period. And you can look at history, and Sentiment Trader did a good piece on this, where you can go back and look at all the times that's happened. And we have never seen a situation where, according to the American Association of Individual Investors survey, people are as bearish as they are now. We've never seen a situation where even 50% of people are bearish on the market after a rally like that, ever. And the only times we've seen anything close to it were the beginning of a very large bull market rally. So, and this is more extreme than that. Hedge funds, you can correlate. You can look at what the benchmark tracking indexes are doing, and see what the correlation is with the S&P 500, and you can get a sense of where hedge funds are positioned. That correlation is below zero. It's the same place that it was back in like last September and last November, when Gavin and I did a number of pieces basically saying that there's a lot of signals that suggest a large rally is coming, and we got that blow-off rally to the upside in December and January, because people weren't positioned for a market that was acting stronger than it should, or seemingly should, given some of the data that we're seeing on the economy. And this is really similar to what we're seeing right now. So that's the universe if you don't imagine that this time is different. But if you imagine instead that what we're seeing right now is just off the map, we're seeing just a fake market effectively because of everything that's being printed, then you can start to question whether or not those historical examples are somehow valid in this situation. And that's, I think, really the struggle in trying to analyze this market right now is, can you trust the data, or is there so much machination behind the scenes? Is there so much money printing, so much big quarantining the economy and quarantining the markets into some kind of attempt to stably treat it like a patient in a critical care ward, that the signals that you're getting that you normally would trust somehow are untrustworthy. And I don't know the answer. Just, spoilers, I can't tell you which universe we're living in. But I think that it's important to at least accept that there's a strong possibility that this market is finding a way to price in the possibility that people are overly pessimistic about how we're going to work through this process, despite the seeming kind of failures that we've seen in a top-down capacity to manage the process. There may be enough smart agency happening on a bottom-up level where, this isn't 1918. It's a century later, and we've got tools to actually manage a situation like this better than maybe it would seem on its face. So the market could be telling us that we're actually going to come through this a lot stronger. But one argument you might make against that is that this is just a liquidity-induced kind of bounce. It really is just based on money printing, and you try to figure out who could be buying is basically all of the money being printed somehow getting shoved into the market because there's no interest on anything. That's a possibility, but I kind of want to warn against being overly committed to a bearish view here. I feel the same thing that probably everybody listening to this is feeling, in terms of, you see the economic data that we have, you see what looks like a collapse that's going to have second-order consequences. It's not just based on the virus at this point, because you start to get some of these businesses that are stagnant for long enough, and it doesn't just switch back on. So I understand that mentality, but the way the market is behaving, you have to at least allow room for the possibility that the pricing function is working and that we live in the first universe.
All right, Brett, so let's touch on a point that you made regarding the money printing, and that being the stimulus for this particular rally that we've seen off the lows. I've tried to think, and I don't really know all the answers, but what would be the risk? Like, at what point can the Fed and the central banks get caught with their pants down, and the market then catches up to the economy if it wakes up and says, whoa, things are not getting any better, things are really, really sluggish, and the Fed is still doing what they're doing, but at what point is it no longer effective and the market just, I don't know, we end up hitting tulip phase and then potentially crash? I don't know, but walk me through that scenario, because it's really hard for me to wrap my brain around that.
I know it's a fundamental question. If you try to support everything this way for a long enough period, the way that we outlined this initially, the idea that there's two dimensions to this. One is depth and one is duration. And we have seen, I think, definitive evidence that what the market cares about is duration. The depth can be infinite. We can see the most horrific. We can see a complete stop in economic activity, and as long as it's short enough lived, then the market's able to see the world on the other side of that, to see the other side of that bridge that we're building with all of this support let's say, all of this policy activity. But that bridge can't be infinitely long. And at some point, yeah, you run into a situation where I think that eventually it becomes, something that starts to show up in currencies. And that's, I think at that point, I think that we're a ways away from that now. But the market is going to be considering some risk of that as you go through this process. It's got to price in the potential for that to some extent, that we start to basically have everything just kind of on this, this sort of false scaffolding. And if that goes on for long enough, then eventually you're going to start to see it more aggressively in terms of currency values versus tangible goods, and that's inflation.
All right, so some of the key indicators that we should watch for is the currency market, probably the bond market, so things outside of the stock market, in order to maybe get a sense that, there's some things, maybe the junk bond market, some things may be falling out.
Yeah, I think certainly we've seen issuance go through the roof, and somehow we've seen the value of bonds, and I think that that's directly because you can issue debt to the Fed. So right now the Fed is just a catch-all, and I think that market signals on the fixed income side, particularly in corporate debt, that's just a completely false market at this point, I think, unquestionably. But that's about the economy, really. That's about whether or not we can continue to support the existence and the stability of organizations that are going to need to be there when we get to the other side of this, whatever that looks like. So I think that that's a valid move, and it's a valid process, and the market can kind of price according to the other side of that bridge. But again, I think that this is going to come down to whether we can find a way to move back into some kind of version, some kind of semblance of normal economic life while not seeing an intolerable pressure on the healthcare system. And it's something that I think that Gavin and I talked about way back in February, that's the dynamic that will matter in the end. Whether or not you can move back into something that seems remotely like normal economic life without placing an unbearable pressure on the healthcare system. And that really comes down to the hospitalization rate and the amount of resources we have to treat people well who all are demanding treatment at the same time. And I think that that's the big variable that needs to not break. And I think we're getting better and better at this. And I think that we're going to get increasingly well. Maybe that's one of the things that the market is starting to see is, the antigen test that's coming out now that was just approved on Friday is an enormous positive. I've been through this directly, understanding the impact of not being able to get quick test results. Testing and the ability to understand whether or not you have this, that's how we see this thing that we're fighting against. Test and trace, and having a quick, cheap, rapid results, widely available test is maybe the most important factor in this entire process. And, what is it, Quidel? What was approved by the FDA.
Quidel.
Yeah, Quidel. What was approved by the FDA. It's super fast. It's going to be everywhere. The machines are already distributed, and it's cheap. It's going to be much more widely accessible, and you're going to have the results, practically feel like they're in real time. Right now I'm waiting for the results of my third test, and I can tell you we're on pins and needles, and I took it yesterday, and I might not get the results until tomorrow. And that kind of blockage in the process is really difficult. It's hard to get the test, and it takes a long time to get the results, and that's a big impediment. If that test was really easy to get for everybody anytime they want it, and they get the results immediately, it just makes an enormous difference. So I think that that's going to be huge. I think that factors like that are really the most important to understand. The testing, the tracing, and the widespread availability of clearly effective protection equipment.
All right, Brett, so I do want to ask about one more risk associated here, and that is, I was talking to Gavin earlier this week, or maybe it was late last week, about how I have a couple of friends who are in the service industry, and they are telling me that, hey, I'm making more money with this unemployment and the stimulus checks than I would be if I was actually in the workplace right now. So therefore, I'm just going to wait this out. And I asked, okay, well, how long are you expecting to wait? At least till July. So That tells
Okay.
me that we're going to have, I'm sure that these are not the only couple of people in the whole universe saying, I'm going to do this. I've realized that I can make more doing nothing and I'm just going to wait this out. And we get to July. That's a pretty long bridge. Now, guess what? We start to enter the autumn phase and the risk that we get a new outbreak of the virus. Now, we've extended that bridge. We've got a potential for another outbreak. What happens then? When is the Fed's hands tied at that point? Is there something more they can do? Do we do this all over again? That's what I think the biggest risk is. We're just going to have to wait a long time to see if that plays out.
I agree with that. However, I also think that so in that first universe I outlined, one of the ways to look at this process is that we're constantly becoming better and better at understanding what it is we're fighting, and better at understanding how it's possible to live with it in a way where we can kind of have more of a normal existence while this is happening. Just again, like me living in a house with, maybe 4 people right in within a few feet of me a lot of the time who have this, and finding a way to not get it. There's ways to exist and to be around it and to lower the transmission rates. Just people getting smarter, and everybody's getting smarter about this every day. Everybody's getting smarter about this every day. And a lot of really smart people are doing a lot of things that we don't know about that are going to constantly start to pop up on the radar, like the antigen test that we just all kind of found out about on Friday. Like lots of different things that are going on that are probably constantly kind of shoring up our ability to deal with this in a way where it's not quite so completely, shut everything down, that's all we can do. But just being rational and reasonable and constantly mounting up our different resources for battling against this, getting faster test results, getting more widespread testing, getting better tracing, getting better understanding. If you know who has it and who doesn't and who's been exposed to it, then you can also know that those people aren't in the restaurant with you. It's about information. And I think that we're getting better and better at that. And I think that the market may be saying something along the lines of, a few months from now, we're going to be way, way better at that than we are now. And that really makes a difference. It's not necessarily the case that if we start to see cold and flu season roll back around, that, we won't have many more resources and tools for dealing with this in a way that makes it something that's not so devastating. That may be what's happening. It also may be the case that we've got an emergency vaccine by then. I'm based on the research I've seen, it seems actually a little less likely than we're hearing. But, I understand that lengthens the bridge. I understand your argument about the unemployment and the perverse incentivization that entails. But if we start to reopen things, then we can also start to, kind of transition back. And so we'll see. I don't really like the way that people are painting the idea of just reopen no matter what. I think we need smart reopening. And I think that that's a puzzle we can solve. And I wouldn't really focus too much on what politicians are saying, because they need to say what they need to say to get reelected. And that's just a fact of life. But it doesn't necessarily mean that that's what's happening under the surface.
All right. So this market, incredibly tough to short based on all the conditions that you laid out. But it's really tough to chase it as well. So how are you planning to strategize any type of equity, any equity positions?
So based on the way the market is behaving and based on the way sentiment is positioned right now, I have to force myself to be in a situation where this is about the overbought and underowned playbook, which is a difficult thing to do, but the strategy has to be to pull the trigger on the long side on headline-driven shakeouts, as difficult as that feels. Until I see evidence that doesn't work. But that's the standard playbook for this kind of situation, where you've got a market that's stronger than it feels like it should be based on the information context, and you see sentiment data like the data we're seeing now, and money market fund flows data, and everything else that just suggests that there's just so many people who are sitting there who have just decided that, this is going to at least retest the lows that we saw in March. There's just people aren't positioned for this thing to just gradually kind of grind higher. If I see a change in let's say good news can't rally the market, we don't see the squeezes, we don't see bears give up every time there's a new marginal piece of good news. We see some big resistance come in. We see maybe people who bottom pick the market well really get on the offer. We see, bad news lead to grinding declines rather than just flash shakeouts that grind back higher, because that's what we're seeing for sure. Then that changes the context. But right now, I feel how bad things are, and I see every reason this market should not be at the price that it's at. But the way people are positioned and the way the tape feels, it just feels like a market where you almost have to just hold your nose and buy into bad news shakeouts.
All right. Well, speaking of that, we're going to shift gears just a little bit and talk about the oil market. Have we seen the bottom?
I think that there's something happening that explains a lot with the oil market. I think that the data on production is just really lagging. I basically, after having conversations with some other people, I think that that's the most reasonable explanation, is that we're getting lagging data on how massive decline in production that we've seen, particularly from the United States. And that, I think, really, may have even overshot, because the second we start to get a little more confidence of getting back out there, you're going to see probably a lot of pent-up demand for energy. Probably a lot of things where people wanted to be doing something that would use more energy, they haven't been doing. And the second that they start to, it could be kind of a snowball where we start to see, we could even see, backwardation come into the curve at the front end in immediate reaction. But, for the June contract, I don't understand how it's possible that the June contract can be behaving the way that it is, even given all of that, because I'm just not aware of enough of an expansion in storage capacity to explain how everybody who's sitting in this is going to be able to take delivery. So it's possible that as we start to get to the roll coming up here and we start to roll into July contracts, we see the front end kind of crash again. I'm going to be real interested in that drama as we go toward it.
And it's really tricky because they have weird rollover timing sometimes. Crude catches me off guard when they're going to roll over all the time. So we'll definitely have to pay attention to that. And we'll look to you for some pointers, and we know you'll be observing that. So I want to bring in Gavin, event trader, into the conversation. Now, Gavin, you and Brett have a show that we'll plug here, the Sentiment and Flow show that you guys do usually weekly. And was there anything that has caught your eye that you want to ask Brett as far as positioning and analysis and some strategies surrounding that?
Not that we haven't fleshed out to a full extent, and I think Brett did a pretty good job there of just highlighting the amount of money that's sitting on the sidelines ready to go to work, and with that, all the monetary and fiscal money that's going out into the world too. So it really just provides what I'm curious about is, has inflation kind of set in on the stock market and valuations, and that's probably the one thing that I'd be looking at, which is one of the reasons why I have that position in gold. I think it makes for a smart hedge right now for percentage of your portfolio. So I don't know, Brett, what's your thoughts on gold here, given some of the, obviously we're getting deflationary headlines when you look at the inflation data, but stock market certainly seems like it's acting more inflationary at this point.
Yeah, so I think where valuations in the stock market are concerned, I think that's about, the markets. It makes sense if there's a world that's going to be coming back into existence that has some kind of robust possibility for, supply and demand at the other side of this, and that other side of it is not too far out there. Then you look at, what kind of economic data is happening right now, and it's just sort of like, it doesn't count in a way. I think that's the market's rationale if you want to anthropomorphize things. As far as gold is concerned, I like gold. I'm looking for some kind of shakeout process. I want to see one more shakeout and buy into the shakeout. And I like gold on the long side simply because it's not overly crowded now. And I think that there's going to need to be, as we trace through this, something that acts as a vehicle to price in some percentage risk of this eventually being too long a bridge and all of this policy action starting to fall in the currency system. And that would mean every currency and against gold. So that makes sense to me for there to be some drama ahead that includes some kind of more aggressive upward movement in gold as people start to price in some more attention on the risk that the bridge is simply going to need to be too long.
Right. And,
I'd like to see a shakeout to buy into to do that.
I think it's going to be tough to find a shakeout too, because I don't know if you've been seeing the difference between spot prices and prices for coins and bullion, with there being a physical shortage of delivery for coins and bullion at this point, which hasn't.
A lot of that's transportation, though, isn't it?
I was seeing it in April. I didn't really see transportation. I mean, I'm sure that plays a factor into it, and perhaps
they can't transport the gold.
Yeah, well, I mean, obviously you need the physical delivery, and but I mean, it just seemed odd that it was that far off the prices between the two. Transportation certainly would make sense, where you got to pay up just for those transportation costs. But I don't know. It's also just pointing to me towards potential shortage out there of physical delivery. You don't see that at all?
I according to my understanding, the disparity there is mostly built of the idea that it's difficult to transport. We've seen differences in pricing for markets on different continents that suggest that it's about a misalignment, the ability to move the gold from one place to another. But I just being somebody who's traded gold a lot, I feel like that we're going to get a shakeout. It's just my gut feeling.
Okay.
I guess I just kind of trust that intuition that we'll get something. Maybe we dive down. We've got what looks like a symmetric triangle right now with an axis of around 1700-ish. I'd like to see that break to the bottom, break out the support, the slope support of that triangle, and then break back to the top. I'd like to buy a small position into the break of the support, and then increase it in the break of the resistance.
All right, getting a little bit of late roll in gold here, actually.
So, Gavin, many of the listeners out there know you as a event trader, and we certainly have no shortage of events that have hit the tape over the last 2 months or so. As far as what you're seeing in other areas of the world, are there any other places that you think might be advantageous? Maybe it's Europe or maybe something emerging. We don't even talk about that anymore. Is it because we're just so focused on what's going on here in the U.S. that we might be missing out on some other opportunistic ideas?
I don't think so. And if anything, I'd be looking at more of perhaps the commodity-based economies that could see a pickup in orders of a global in the context of a global recovery. But I mean, it's difficult to get too excited outside of the United States. I mean, if you look at Europe, they're having a tougher time with us in terms of their policy response. They seem to be getting a little bit ahead of the virus, but when you start looking at the ECB and you get that German court ruling a week ago that suggested Germany shouldn't legally be allowed to participate in some of the bond buying programs that the ECB does, we can see the cracks that are underneath that system. That makes me a little bit more tentative to buy into there. With China, that would make the most sense considering they can be viewed as being ahead of the game in terms of recovery. But I don't know how this U.S.-China debate over where the virus started and how that's going to impact trading, how that could continue to impact China. I don't know how their global standing in terms of the supply chain is going to be viewed if they continue to see hit back from where they are, where everybody's sourcing their supply chain and wants to move further out of China. They're therefore hurting the economy that they've basically spent the last 20 to 30 years building. So China I would prefer over Europe, but really for the most part, I kind of like the U.S. here, given the amount of money that's being put into play, given the fact that we could be seeing some manufacturing moving back into the States and helping create jobs. So I'm not as excited to jump out in other areas, but if we did see a global economy recovery, a place like, Brazil that's commodity-based driven economy that could see a nice bounce back, particularly if it was coupled with a weakening of the dollar as people move out of it from a safe haven, then the EWZ would be an area that I'd be looking at. But for the most part, I'm much more interested in the micro than the macro, because I feel like the micro I could stock pick and grab winners in certain areas that I think will benefit at least over the next couple of months. Where the macro, that could be a little bit tougher to gauge where people are going to be going in the next couple of months. So that's how I'm looking at this market right now.
And for all those listening out there, Gavin and I run through a whole lot of micro stock picks and analysis in our pre-market. So you'll hear a lot of those calls that he has on a regular basis. And then not only that, he goes through earnings with Blue Chip Trader in the afternoon, and they preview earnings, they talk about charts and whatnot. So I think that might be a good opportunity to bring in Scott, aka Blue Chip Trader. How are you doing today, sir?
Hello?
Yay, Scott.
Hey, how are you? Sorry, I was on, couldn't find my mute button.
Yeah, that's okay. The mic always works better when it's on. Anyway, so Blue Chip. So I brought you in because I know you and Gavin run through a lot of earnings. Now that we're past earnings season, and some of those catalysts that you look for are kind of out of the way, how are you gonna? What's your plan as far as how to trade into the summer hour, the summer time frame? Because we don't have as much specific earnings catalyst and gap reversals and all those types of things. So what's your game plan?
Well, there's a lot going on, and obviously it's tentative based upon the bigger picture that's developing. But like these other guys said, there is still a lot of money that has moved to the sidelines. There's somewhat been a fear of missing out trade going on over the course of the rally, especially amongst the technology and healthcare sectors. And I think those are really going to be the best areas to focus on. Now, short term, I'm not really the biggest advocate of chasing a market, specifically in the NASDAQ, that has run up 5 days in a row already. It already has a series of higher highs and higher lows in play. The QQQs is also running into the bearish gap from February 24th. So it's trying to close that window there between about 224 and 229. And it's kind of sitting in that no man's land. I suspect the momentum is going to die down here a little bit and go into a little bit of a consolidation phase. What I want to really pay attention to, though, is how this next pullback consolidation phase is really handled. And when I say that, I mean I want to see these leading stocks in technology, in software, in gaming application, in online shopping, in internet, social media, cloud, sky, cybersecurity, automated trading, even semiconductors I would throw in there. I want to see how all of these technology names that have acted as almost a safe haven during this entire global slowdown pandemic that we've had here the last couple of weeks, I want to continue to focus on them. That's where the money has been focused for years, and it seems to continue to be driving there. So I think those are going to be the best opportunities. On the flip side, healthcare is actually holding up pretty darn well. And I highlighted recently that biotechs have been breaking out to multi-year highs. So whether it's the IBB or the XBI or the BBH, those are all breaking out significantly to fresh 52-week highs. Last time we saw such moves like this was about 5 or 6 years ago, when biotechs were hot and they were on that super 1 to 2 year parabolic uptrend. And you could make the case that they have been somewhat consolidating and sideways for the last few years, and now they're starting to emerge on that next leg higher based on the monthly charts. If you take a look at the swing trader column, the most recent one, I do highlight a few of those charts there. I'm not a real big advocate of going after individual biotech names because of the risks that are associated with drug approvals. A lot of these companies are only one drug companies that they heavily rely on for revenue. So I typically would just, if I do want to participate in the upward move of the biotechs, I would just basically find one of those leading ETFs that I highlighted and participate in that. But again, I'm not really chasing breakouts at this time. I want to see how they consolidate, how they pull back, if they hold onto key support levels, 50-day moving averages, and to continue to focus on those two areas, technology and healthcare, into the summertime. One group that is a big concern, I will say, going into the summer, if things do turn sour, are the financials. Financials, the XLF, we've got the dead cat bounce pretty much across the board there with every sector, but financials have been significantly starting to not participate over the course of the last 2 to 3 weeks here in May, and their relative weakness, I think, is starting to shine through, and I think it's raising a lot of concerns. If the lasting effects of a economic slowdown is going to take hold, and you're going to see perhaps bankruptcy claims or just a really slow recovery effort overall, or second wave of this pandemic, I think financials are really sort of reflecting that possibility out there. And I think they have to be monitored pretty closely. I am leaning short term, on the short side for them, for a couple of my swing trades, but we'll see how that continues to play out. So those are the two. I would say those are the three main sectors that I'm focusing on going over the course of the next few weeks throughout the summer. Would be look for pullbacks and strength to continue in a lot of technology and healthcare spaces, and then really for the short side, I'm mostly focused on financials. A little concerned about energy. I think energy, has gone a little bit too far ahead of itself with that bounce that it's had here. Perhaps it did turn a corner. Maybe the worst is behind it. But I'm willing to trade energy from both sides of the spectrum here, going forward. But I think there's going to be a lot of opportunity. I think volatility is still going to pretty much, even though it's come in significantly, is still going to be pretty high. And there's just going to be a lot of nice short-term trading opportunities for those who are really kind of alert and aware of the rotations that are going on amongst leading groups.
So is it safe to say, in terms of your overall strategy, that the way you come into the market is, we'll use financials for an example, you see overall weakness, it's not participating with the rest of the market, so therefore you identify the sector and then you look for the names that you want to attack within that sector, as opposed to playing an ETF?
Yeah, for the most part, yeah, that's a good. That's definitely a good general assessment. It depends. It depends on the setups. If I, like today, for example, I went after Goldman, and why did I go after Goldman instead of going after J.P. Morgan or Wells Fargo, which were clearly already undercutting, 3-week support levels? Goldman just provides more volatility. For somebody that I like to trade, stocks that move multiple points as opposed to percentages on a daily basis. So that was just kind of my go-to look there. And then the way it was just set up, Goldman has been showing some strength as of late. It wasn't as weak as JP Morgan and Wells Fargo, but it was really kind of the low risk entry point that I saw on the setup there this morning, that I felt like, all right, I am going to be proven right quickly, or I'm going to be proven wrong quickly. And those are the type of trades that we talk about, we try to take all the time. It's these tipping points or these line in the sand type of moments on the chart that if you can get in, you're not going to be really hanging around for an hour or two, to see if you're right. You're going to pretty much know you're wrong or right quite quickly. And when things start to turn, you just get out. You take your losses, and then you wait around and wait for that next opportunity to develop. So it's hit or miss for me. Usually depending on if I know a company and if I know a stock and if I like this chart, I've been tracking it, I'll go after it. If there's just too many names to choose from, like for example, I did just recently go out and short the IGV. This is a software-related technology ETF. It's because I'm looking at all these names and they all move in tandem with one another. They're so related that I'm not going to sit there and just kind of go after one. I feel like if they all start to move, then obviously the IGV is going to go with it. So it really kind of depends on what sector I'm attacking and the patterns that are developing out there.
So if you were looking for an ETF, it would have to have some type of volatility that would get you interested in it. Like IGV, there's just so many names that it makes sense. Instead of having a bunch of shorts, you can just short this one, and that's got good volatility. So those are some of the things you look for as well.
Right. And it's I probably wouldn't short the XLF because it is pretty thick in the way that it moves. But something like a contrarian weighted ETF like the FAZ, I mean, I would go after something more like that just because it has a lot more movement to it. It has a daily range of approximately $2.50 to $3. So I know it's just going to get a little bit more bang for my buck, so to speak.
Yeah, and those are good for day trading. And I'll tell you, a guy who has really stepped up his day trading lately is Trend Tracker. And I'm going to bring Craig in and talk about what he's been doing lately. Now, he made his mark really finding these hidden gems and getting these big runs. And we've talked about names like TTD as one of them, where he made, I don't know, 4x, something like that. I mean, 400% at least that I can recall. And he holds these trades for quite a while, long-term swing trading, if you will. But I've noticed, Craig, that you've been day trading a whole lot more. So I want to pick your brain as to how you identify the stocks that you actually want to day trade.
Well, I've been day trading more, and I've been technically, kind of bearish for better part of a month now, and I haven't been necessarily doing very well. Luckily, the strongest areas of the market, technology and biotech, are where I have most of my investments in swing positions. So as a whole, I've done well, but my short-term bias has been on the short side for a while now, and as all the dynamics that Brett was kind of talking about, I'm kind of along. I'm with the crowd here, but it seems to be that it's really just a contrarian fighting the trend, which hasn't gone well. I look at a lot of these software stocks that are all just on fire, and the valuations are really hard to grasp at this point. So my bias is to the short side, but it hasn't been really working very well here in recent weeks because, much like we saw indiscriminate selling in late March, over the last week, we've seemingly seen indiscriminate buying in software, and I get that. I kind of like the fact that the market is thinking long term, because a lot of these companies are benefiting from an acceleration in digital transformation, but at some point it just feels like it's kind of gone too far. So the disciplined investor in me makes it hard to kind of chase. Last week, I mentioned Wix as a potential setup, and
WIX,
yes,
the ticker WIX. Okay,
correct. I mentioned it pre-market. It basically gapped up a little bit, took off, went straight up ever since, and I missed it. I kind of came to the realization last week that you just long software, you just got to keep going with it until it stops working. But in my personal experience, I found that if I capitulate and just start going long adding to software exposure here at this point, that's when it will reverse and I will get it handed to me. So the disciplined investor in me is kind of preventing me from adding to software exposure. I already have plenty of it, but at some point, I would think that this extreme sentiment in technology is going to wane, but it hasn't happened yet. So
you as trend tracker, the name speaks for itself. You've been able to identify things that are going to happen pretty much ahead of time. So coming out of the whole COVID thing, now that we've been involved in it and we've seen some of the names that rode the wave higher as COVID became more and more prevalent, names like Zoom, a name, I know you weren't involved in it, but Logitech, it makes sense that the whole stay-at-home play with headsets and webcams and whatnot, that a stock like that would move higher. So now that you've seen what has moved and now that we're involved in the COVID, what are some of the things that are brewing behind the scenes that you may be working on?
Well, there is at least what's working is, sort of obvious online retail, pretty much anything software. The one that I had mentioned as a potential setup, and it's actually breaking out right now, is JD, which is the Chinese online retailer. They report Friday morning. There's another Revolve, which is a
what's that ticker, Craig?
Revolve, RVLV. They report tomorrow afternoon, and this is kind of an IPO that was kind of a flop. It's an online retailer. They have a kind of a different model where it's more through influencers on Instagram. So obviously the retail sector has gotten crushed, but this might actually be one, they warned about how things fell apart in March, but it's possible that, like in Etsy, that April kind of blew up because it's, an online retailer. Now, I don't have a position in this one. It's heavily shorted, but this is one where, perhaps they do have good things to say. What we have seen over the last few weeks is, as long as there's been improvement recently, that's enough for investors to pile in. We've seen that in the market, that any kind of recent improvement, May is more important than April, or April is more important than March, and if your long-term positioning is good, then the market is kind of pricing that in and discounting your strong position. I don't know if RVLV is going to have any good news to speak of, but it's possible. It's not a brick and mortar retailer, so they're well positioned than a lot of these other specialty retailers. Retailers are going to start to report next week, so it's definitely going to be interesting. I mean, there's the rest of the year. Obviously, it's just going to be a lot of good and a lot of bad. So it's not going to be too many dull moments. I mean, this summer normally things start to slow down a lot here after this earnings season, but this year I think there's going to be fireworks all summer long, so it should be interesting.
All right, so that RVLV, Craig mentioned that there's a high short interest. Now, a guy who is really savvy at finding short squeeze potential names is Damon. So I'm going to bring in Scalp Trader. How are you, Damon?
Hey, I'm doing well, Jim. How about yourself?
I'm doing all right, and you've been somewhat quiet. Let's face it, man, you had an impeccable run over the towards the end of March through April. Big winners in a lot of the energy names and the REIT space. I mean, that's just to name a few. I mean, you were actively day trading as well. You've kind of ratcheted things back down because things are pretty choppy, but I know that you're working on some things while things are a little slow for you. So what are some of the themes and items that you're looking at here as we enter post-earnings season?
Yeah, so still thinking about the themes that'll develop kind of in this new COVID world. And, as I noted yesterday and just posted a comment a few minutes ago that, I like grocery anchored open air strip centers. And I think people just really aren't going to venture far from home. They really don't, have to go to their offices or working from home. And you have to get groceries. You might want to stop at Chipotle. I meant to send you guys a picture of the Starbucks down the street from my house. Literally, the line for the drive-through at pretty much all times is about 4 to 5 blocks long.
I believe it. I see it. I've gone to the shopping centers around me out in the burbs here, Damon, and they are, oh gosh, how do you say it? It's 3 or 4 parking lots deep for the Starbucks and a couple of the other places. So yeah, I believe you, man, when I see that. But so I mean, I guess that's good for Starbucks. Should we be looking at that one?
Starbucks, but also good for these strip centers. I think that all the REITs are kind of being painted with the same brush, and strip center REITs are getting thrown in with mall REITs, and I think they're just totally different animals at this point. So Kimco, KIM is a name that I've mentioned, trading around 965 right now, has a yield of 11.6%. I haven't officially put it in the portfolio yet because REITs continue to act really heavy, so I think that it can be bought at a better price. And I think that if as the economy starts to reopen, if we see a spike in virus cases, coronavirus cases, COVID cases, these REITs will take another leg lower. Well, I think the entire market will take a leg lower, but REITs in particular will take another leg lower. So I'm just saying to put this one on the radar, but I think this one could be a really attractive long-term winner as people really start to pay attention to what will work in an environment that where you basically have a COVID cloud and not having a vaccine and people still just being very cautious. I think these strip centers where people go to pick up Chipotle or pick up Starbucks, get their groceries, those are things that'll really work. And there are a few more names in that space that I'm researching, trying to figure out how much exposure they have to just pure strip centers versus having a mix of other things such as malls. But Kimco seems to be the cleanest play at this point. Another
that ticker's KIM, right, Damon? KIM?
KIM, yes.
KIM, okay.
Yeah. And again, I'm not aggressively buying it yet just because REITs still feel really heavy. And I think that if we start to see an uptick in virus cases as the economy reopens, then they're going to take another leg lower. So my goal is to accumulate names like this into lower prices for the long term. And I wouldn't surprise me to see this, double from its current price. And if you can get it lower, more than double. Another name that I'm looking at, we already have positions in ASPS, which focuses on foreclosure workouts. I think that you will start to see more foreclosures over the next year, 2 years. And the fact that there were so few, this stock was trading around, before the market tanked, the stock was trading around 17, 18 in an environment where there were no foreclosures and basically a very strong housing market. And it fell from basically around $20. It fell from $20 down to about $6 just because of the market downturn. So I think this is one that should get back to pre-crisis levels, back up to that $17 to $20 area, possibly higher, as people start to look long term and focus on what the world will look like a year from now, 2 years from now. OCN, which is another one that we have in the spec portfolio, Aquin, they focus on mortgage servicing. And I was on their conference call last week, and they're saying that the MSRs are at the highest level they've seen in basically ever. And so the ability to buy mortgage servicing, the returns on mortgage servicing right now are so compelling that they're feeling like they're literally getting the rights for free and the returns of 25%, which is super compelling. And I think this is a name that could return significant upside over a 3 to 6 month period, possibly less. Their book value, I think when I put up the trade last week, it was trading at 0.15% or 15% of book value. So quite a steep value disconnect there. We've had about a 30-40% gain in that since last week. So, but it's still pretty much trading near 52-week lows. So I think there's still some opportunity there. I was on the Camping World conference call last week, and that was one that I was kind of buying early, saying that I think people will basically buy RVs and rent RVs as a new vacation opportunity, new vacation scenario. And Camping World said that, I think last Saturday, not this, 2 Saturdays ago, was their busiest day in history. They are seeing so many people that are booking RVs to basically take their summer vacation as a family. And so instead of flying somewhere or taking a cruise or whatever, they're just booking RVs or buying RVs and planning to go to the lake or some public park or wherever people take their RVs.
Yeah, that was definitely a really nice one, and you can see the chart here in Camping World, CWH. Looks like it has some room to run there, and especially if this theme continues. Damon, are there any other spaces that you're looking at as far as opportunistic places that you're doing some research on, or are you just focusing on that?
Well, the the used car lots and the big car dealers seem to be doing really well. There's expectation that people will start to drive more, use less public transportation, and you're seeing that play out, and especially in places like China, where you're seeing a big uptick in gasoline purchases and people driving to wherever they're going versus taking public transportation. Those stocks have done really well. I mean, I think the way that we were able to participate in that was what was the stock that we bought in March? The big used car dealer that brings
Carvana,
it out.
CVNA.
What is it?
Carvana, CVNA.
Carvana. I've been through so many tickers the past month, I'm starting to lose track of some of these names. But yeah, Carvana, used car prices are down significantly. They don't hold a lot of inventory. They're basically one of their big businesses now. And obviously we bought this in the low 20s. It's run to 97.50. But it's, kind of interesting. You have names like CarMax and AutoNation that have had big bounces, but that's just one trend. I mean, I think you probably are going to see, maybe like auto parts stores, guys like that, where people are driving, as miles start to take up, people start to drive more, have to repair their cars. So that could be an area of interest as well. But I'm really curious to hear any other ideas that people have that may benefit from this, from the kind of current state of affairs that we find ourselves in, where things may, just in terms of how things may play out over the next year or two, different opportunities.
Well, Damon, the first one as a derivative play that I thought of was the auto parts stores. So you've got Advanced Auto, AAP, AZO, and there's probably a couple of others out there that you can look to. Probably Goodyear Tire, those type of things might play into that theme as well. I do believe that Gavin had a few plays. I think I might have cut him off for some of his ideas. So please, Gavin, take the floor.
Yeah, Jim. I doubled down on that CWH that Damon mentioned. We talked a lot about it when it reported earnings last week, just as a savvy play. And a build off of that, too, I think, is this YETI Coolers, which hasn't launched as high. But if that starts grinding up over that $30 mark where the 200-day moving average is, this could be a nice winner. And I could see that really playing out as a nice supplement to that camping theories. So they're two names that I got on my radar. Go Grocery Outlet. We talked about that one today. The company's looking like a potential breakout candidate. We see the strength that's going on in the grocery markets. They recently just digested a 10 million share secondary offering, so there's no dilutive action that could be a threat for anybody that was looking to get involved with this. So, as a breakout candidate where they were running some really strong margins, their same-store sales was 17% for the quarter. That's some pretty good numbers. So I definitely like that play out there. Another one that we talked about a little while ago, Carrier Global. This one's starting to edge higher. It's just a strong play across the board on these COVID-19s. Brett, at the beginning of this, was talking a lot about air circulation and, having the proper ventilation there. Carrier Global, being an HVAC company, falls right into that spot. They also have secondary businesses where they're helping create medical devices. They have a new product that they just launched that's specifically set to filter out air in rooms, and they also have storage delivery. We've heard a lot about frozen storage delivery, I should say, for food. We've heard a lot about the shortages in the food supply around pork and meat, and also fish too. 85% of all seafoods sold to restaurants. So Carrier Global, across a number of different areas, hits pretty nicely. It's still cheap compared to JCI or an LII, Lennox International, which are its competitors. So you can get it at a discount. And I think the reason why it just did so poorly around the IPO is I think a lot of people that owned UTX, which spun this off, woke up one day and wondered why they owned an HVAC company and just went in and sold everything. So that kept this cheap, but I still see some upside to it. And then looking at the cybersecurity plays, obviously a lot of people are going to be working from home. You've heard a lot about Zoom and the issues people have had with randoms jumping online here and stuff. So cybersecurity is going to be continue to be a strong play. And I like this proof point here, PFPT, as a play in that area. I know Craig's got a couple of plays in there too. I think CrowdStrike might be his favorite. So, that's a strong area that I'd be looking at. But there are a few of the names that I definitely have out here as winners in the second half of 2020.
And that ticker for Carrier Global is CARR for anybody who might be curious on that. All right, gentlemen, are there any parting shots from anybody that last call?
Jim, I did want to add Elastic is one that I kept accumulating during the downturn.
What's that ticker, Craig?
ESTC, Elastic.
ESTC, thanks.
Yeah. I was buying Livongo in March. Unfortunately, I dumped that one, and it's doubled since. But Elastic is probably the one that I really accumulated the most aggressively down near the lows. It's finally broken out of this downtrend, this weekly downtrend here over the last few days, and now it's kind of trying to perk above the 200-day. This is one of my biggest positions now, and unlike a lot of these other software companies that are growing at a similar rate, it's really only trading at like 10 times forward sales when there's a lot of companies trading at 15, 20, even more than that. So This is a software stock that actually has lagged quite a bit, so I continue to see value here. This is a longer term play, so I'm kind of resisting taking short term profits because I really do like it long term, but one that maybe could maybe still see some catch up. Yeah, so that's Elastic, ESTC.
All right, anyone else have any final thoughts? Going once? Going twice? All right, gentlemen, then we will wrap this segment up. I want to thank you all for joining us today. It's probably one of my favorite segments that we get to do on a monthly basis. It gives us some insight as to what you guys are thinking and helps us prepare for at least the weeks ahead. So I want to thank you for joining us. Thank you for listening. And the good news for everyone out there is that if you missed any part of the segment or you needed to hear a name or a ticker of something that you didn't catch, we should have the audio up later this afternoon, the audio archive. So look forward to that. Listen to it as many times as you want. Again, gentlemen, thank you very much for joining today.
Thanks, Joe.